inflation reports over the next couple of days. Dan Greenhaus is with us, chief strategist for Solus Alternative Asset Management, live at Post 9. Welcome back.
Thank you, sir.
You feel pretty good about where we are?
It's hard not to. I mean, it's a good year for most sectors. It's a good year for most cap sizes. It's a good year for most asset classes. I don't know why you wouldn't feel pretty good.
I know, but therein lies one of the issues. People say everybody is now too positive,
Sure.
right? There's on the doorstep of euphoria, and it's knocking pretty hard. Are we there? Close? Not at all?
Listen, I don't think we're on the doorstep of euphoria, but I think there's my view for the better part of a year or two now has just been let's just acknowledge that things are going pretty well. Corporate profits are doing okay. The economy's holding up. The worries about the consumer consistently have proven false. And in that type of environment, the bias for equities is higher. And then you layer on top of that just the idiosyncratic strength in the AI story and the mega cap tech stocks. I don't think we're on the doorstep of euphoria now.
I mean, Evercore ISI today agrees. They say it's not extreme enough. Like, valuations are stretched. A lot of people think they're stretched. Are they too much? They suggest not enough yet, given the fact that the Fed's cutting and the economy's strong.
Yeah, listen, the only time you really know that valuations are stretched is in the benefit of hindsight.
When it's too late?
When it's too late. Listen, is 22 times forward earnings high? Sure, but it's not as high as 24 or 26 times earnings. And until you go back down to 15, 18 times earnings, you can't look and say that's too elevated. And my point has just simply been, for the bulk of the year, why should tomorrow not look like today and yesterday? And if the fundamentals behind the AI story are in place, and they still are, the economy is continuing to do well and profit growth is expanding out, I don't know why. Valuation is not a market timing tool, as every strategist will tell you.
So given what I told you is kind of the backdrop, new administration, you got Fed's cutting, economy remains strong. What does that mean for where we can go next year? I got a 7,100 price target today from Oppie. That sound reasonable?
Yeah, I can get you to 7,000 pretty easy. If you have a perfectly normal December, and we're halfway through the month already, so this is less cool than it would have been 2 weeks ago.
Well,
but
seasonally is strong to begin with.
It's seasonally strong to begin with. If you have a perfectly normal December, you're going to get to call it 6,200 by the end of the year. And then if you have the 10 to 15% earnings growth that's likely next year, or I should say forecast next year, that gets you up to 7,000 right there. Now, obviously, it's a little more complicated than that, but no, I don't think 7,000 is a bit of a stretch. And again, we're talking a lot about the rotation. The bias is higher. What do I do in that type of an environment? Is Mag 7 going to continue to lead? My argument has been that there's plenty of other stories going on here beyond Mag 7, and you can see that in the equal weight, the mid caps, et cetera.
I mean, is 7,000 a kind of baseline look, or is that everything has to go right, or a lot has to go right to get there?
Well, listen, I know for some strategists on the street, it is the bull case is 7,000. I think I'd probably put myself closer to the camp that thinks it's more of a base case.
Wow.
But you say, wow, but again, 10% next year to 11% next year, not particularly off the charts. If I told you we were going to be up another 25 or 30%, then maybe wow. But I don't think 10% on top of what we've already experienced is. Let me again just be clear here. The Mag 7 is doing great. The net income growth for NVIDIA, 50%. For most of those names, Oracle, Avago's a little better, I think. 10 to 15 to 20%, let's say. Netflix is in that camp as well. But listen, you've got Walmart and Costco doing exceedingly well. You've got the demise of New York City office. Take a look at the charts of SL Green and Vornado. There's all these different stories to which I can point. And then you layer on top of it the rebound in the DocuSign, the Lululemons of the world that just put together pretty good quarters. The dollar stores, which are on the front lines of the tariff war, not terrible. There's plenty of different themes playing out here beyond Mag 7 that support the idea for higher prices.